So if you're brand new to options trading, what should your very first options trade be? This is a question that I get on occasion, and it makes sense. Hey, I'm brand new to options. I just opened up an account. I'm ready to start trading. What should my first trades be? What strategies should I use? What tickers should I look at? Let's talk about it. So let me switch over to my trading platform. And of course, I'm using TASTYTRADE as my trading platform. If you're brand new to options trading, TASTYTRADE is the best trading platform to trade options, bar none. It was created by people that have been trading options for nearly 40 years, professional like floor traders back in the 80s and 90s that eventually created Thinkorswim, and then they sold Thinkorswim, then they created TASTYTRADE, and it's just a fantastic options trading platform. I actually have an affiliate link to TASTYTRADE in the show description, so if you want to open up an account there, I'd appreciate it if you use that link because they will give me a few bucks if you sign up using my link. So I think the easiest trade to start with, if you're coming from the stock trading world and you're used to buying shares of stock, it's something you already do. If that's how you've been trading, is you go and find a company that you want to own and you buy some shares. Let's use NVIDIA in this case. I don't have a current NVIDIA position. So let's say that this is something you normally would do. You would go and buy 100 shares of NVIDIA, right? Instead of going and buying those 100 shares of NVIDIA, instead go to an options chain, go around 60 DTE, in this case 55 days is the closest to 60 days, and then go and find somewhere around the 20 delta put. In this case, I'll go to this 18 delta put and sell the put, right? Get short the put around 20 deltas. In this case, you will receive $340 credit. That's your max profit on the trade. So if in the next 55 days, NVIDIA at expiration in 55 days, as long as it finishes above 155, you get to keep the entire $340 credit you received on that trade. But here's the thing. If NVIDIA falls below 155 at expiration, you will get assigned 100 shares of NVIDIA, which you were already willing to pay 178 a share for, right? If you were willing to do that today at regular price, well, in 2 months, would you be willing to buy 100 shares of NVIDIA at $155 a share? And keep in mind, you'll also still receive the 340 credit, so you're really getting the shares at a price of around 151.60. Would that interest you? So think about that. If you're willing to buy NVIDIA at 178 today, would you be willing to buy it at 151 and change 2 months from now? I would guess for most of you, if you're already used to buying maybe shares for a long-term passive portfolio, don't just go and buy shares today at the current market value. Instead, get long those shares by selling puts. This is practically a risk-free trade in the sense that if you were going to buy it anyway, if you're going to buy the shares anyway, just use the options, right? The options just make sense. You get this premium, you get this credit. Also, if NVIDIA never trades down below 155, you get to keep that premium. And then, you know what? Put on the next trade. Sell another 20 delta put at 60 DTE. Just keep doing that over and over again. Keep making about $300 to $400 every 2 months, right, on the trade. And you never even have to buy the shares, which shares are expensive, right? Selling this put only cost me $3,100. Buying shares of NVIDIA is going to cost me nearly $18,000 if I have to put up the full amount. If I get a 50% discount, which most brokers will give you about a 50% margin relief on that, I would still have to put up about $9,000 for 100 shares. Only have to put up $3,000 for this one short put. So that is a great first options trade. If you want to get long shares of stock anyway, sell a put to get those long shares. Now let's also talk about a great first trade if you already own shares of stock, because maybe you're sitting on a portfolio of stock, a long-term passive portfolio of stock. Maybe you have at least 100 shares of NVIDIA right now. As long as you have 100 shares of NVIDIA, you can sell a call. And this is a rather risk-free trade because you already own the shares. So sell, and what I would do in this case, I would sell around the 30 delta call. Again, we can stick with 55 days. This will be fine. And in this case, selling the 30 delta call, you will receive $515 credit. And if NVIDIA does not trade above the call at 55 days, when expiration happens in 55 days, you get to keep the 515 credit Plus, you still have your shares, and maybe the shares appreciated. Maybe Nvidia actually went up over that time, so your shares appreciated in value, but you didn't get the shares called away because you weren't assigned on the short call, so you get to keep that premium too. It's a win-win. That's the perfect scenario, that Nvidia goes up, but it doesn't go up too much, because then you win on the shares. You went on the short call, great. But let's imagine Nvidia does go up above your call. Well, guess what? You still get to keep the 515 premium, right? And now you have to sell your shares at $195 a share, which you bought, assuming you bought them today, at $178 a share. Well, that is $1,700 of profit on the shares, plus the 515 credit you receive on the call, right? This is, again, it's a no-brainer kind of strategy. This is known as a covered call, where you have 100 shares of stock and you sell a call against it. And this is great if you don't mind selling the shares. So if it's a very long-term investment plan where you've been sitting on shares for a while, they've appreciated greatly in value, you may not want to do a covered call because you may not want to sell those shares, and then you may face a tax bill because of the capital gains. But for short-term trading, if you don't mind running covered calls for short-term gains, this is another great first options trade. Now, selling puts to get long stock or selling covered calls on existing stock is great for those with a larger account that's you're already holding shares. But what if you don't have much money to start with? A lot of people start trading with, say, $5,000 to $10,000. At a minimum, I would say start with about $10,000 because anything less than that is very difficult to deal with. But let's say you start with a $10,000 account and you can't go sell a naked put in Nvidia. It's too big of a trade because the buying power is $3,000 on the put. If the put got assigned, you don't have enough money to even buy the shares, right, with $10,000 or less in your account. So a great first trade, and one that has positive expectancy, meaning this just wins over time. If you do it enough, you're practically guaranteed to come out ahead. This is one of my favorite trades to do over and over again. It's selling put credit spreads in SPY or QQQ. So the way this works is you go out about 60 days and then you go sell the 35 delta put, or as close to 35 deltas as you can get, and then buy a put $5 below, because again, this is for people with smaller accounts, so we're keeping the trade small. But if you got a bigger account and you wanted to do this trade, just make the spread wider and it will actually make the trade bigger. But the $5 wide put credit spread, because it's $5 wide, right? Everything in options times 100. So it's really a $500 wide spread. And in this case, this put credit spread, I would receive a 111 credit. It's $5 spread. So $5 minus 111, my risk on the trade is $389. So I'm risking $389. That's the max loss, or a chance to win 111. So the way this works is if the stock goes up, it's a bullish trade, a put credit spread. In this case, if SPY goes up, I have the chance to win 111. If SPY drops hard and finishes below the spread, the long put in this case, that results in the max loss of $389. Now, my recommendation is you put these on at 60 DTE. Again, sell the 35 delta put, buy the put $5 below, and then here's how to manage it. Take it off if it reaches 50% max profit. So in this case, if we got to around $56, that would be 50% max profit. Take it off for the win and then put on the next trade. If you never get to 50% max profit on the trade, then at 21 DTE, take the trade off for a win or a loss, whatever it happens to be. And the reason you do this, the reason you manage it at 21 DTE, you will never come close to the max loss most of the time. It's very rare. If you manage the trade early at 21 DTE, you'll never have to really worry about this $389 loss. Typically, the largest losses you'll face, 100, 150, maybe $200 because you manage it early. And again, take it off early too, as far as the 50% win rate. And if you do this strategy has a really good positive expectancy, because our pop on the trade is 64%, but if you manage it at 50%, you win 91% of the time on this trade. So put credit spreads in SPY or QQQ. You could do the same thing in QQQ, which is the NASDAQ ETF. You could do something very similar. Go find the 35 delta and then go $5 below and buy that put. So this is the put credit spread. In this case, I'd receive 118 credit, max loss 382. Once again, manage at either 50% winner or at 21 DTE. whichever comes first. And finally, a lot of people want to do naked options, especially naked strangles, but maybe you have a smaller account. What are some less risky kind of things to go sell some naked strangles in? Well, I have some ETFs that I like to play. One of my favorite ETFs to play is GDX, which is the gold miners ETF. And it's only $60 a share. So if you have, say, at least $10,000 in an account, a smaller account, you certainly have enough money to go sell some naked strangles in this product. And for me, this has been one of the best performing stocks of 2025 for me. I've been selling strangles over and over again in this all year, and it's paid off. I don't know if I've even had a losing trade this year. This has actually been a really good product to trade. And in this case, doing around a 1 standard deviation strangle, I get 151 credit, really nice credit, $151 on a buying power reduction of only $600, right? So your risk reward, you're risking about $600 to make 151. Now, technically you have unlimited risk on naked options, but realistically you can use the buying power as your max loss figure, because the broker is calculating that 95% of the time, $600 should cover your losses. That's why they have you put that up, is because that's how they calculate it. And have you put that up because in their mind that should cover most of your losses. So if you have an account of 10 grand, this is a very safe trade. You're only using you're using less than 10% of your account size, which is good. In this case, you're probably using somewhere around 5, 6, 7% of your account size, which is fine on a smaller account. Some other similar products as far as ETFs, so not single stocks, which can be risky. Let's do ETFs. How about IBIT, the Bitcoin ETF? Go about 60 days. Put on somewhere around a 1 standard deviation strangle, right? And in this case, we receive 157 credit. Buying power reduction here is a little higher, $1,500. Buying power is a little high in the Bitcoin ETF because I guess the broker considers this a little risky. But this would be fine if you had, say, $25,000, $30,000 account. I think you would be fine putting on strangles in this. Some other ETFs that you could play things like Jets, especially with a lower priced account. This is a very small share price, as far as $26 a share for the airlines ETF. If you wanted something silver related, SLV, the silver ETF, which mirrors the silver futures, only $35 a share. You certainly can go do all the naked options in that. Well, not all. Let's not get crazy. But with a smaller account, you could certainly go sell 3 or 4 contracts of a strangle and SLV and be okay. So there you have it. A few ideas on what to get started with your first options trades. Number 1, go sell a put on a stock that you don't mind owning the shares. If you already own the shares, do a covered call. Regardless of what you have going on with shares, go sell some put credit spreads in SPY and QQQ. That's a good trade anyway. Everybody should have some of those on. And other than that, maybe do some strangles and various sector and industry ETFs. Go sell some strangles in GDX or IBIT or SLV or GLD or KRE. Pick a sector, the energy sector, XLE. Go sell a strangle in that. Go play around a little bit. Put on a few different kinds of trades and just get started. The main thing is you got to get started trading. You're never going to learn how to trade by reading books or watching videos. At some point, you just got to go do the thing, and you're going to stumble along the way. There's going to be some losing trades. You learn from the losing trades, though. Consider that your fee. Consider that it's almost like buying a course. Instead of buying a course from some trading guru to learn how to trade options, instead learn from the market, right? That's your course, right? Go pay the market to learn how to trade options. Best of luck, guys. Peace.